Outside the FTSE 100, it's a very busy day indeed for company results. Among the standouts is the Mr. Kipling cake maker, Premier Foods. Its shares currently trading up just over 1.5%, but the merchant bank Close Brothers is off just under 3.5%. That's on its numbers. On the foreign exchange markets, well, the pound fell yesterday on the softer than expected inflation data. Sterling off another 1/7% or so against the US dollar. It's off 1/4% right now against the euro. The single currency, meanwhile, more or less unchanged against the dollar. Well, joining me this morning is Freddie Cahoon, Investment Director at JM Fin. Freddie, good to see you. Thanks for waiting so patiently. Let's start with Hotel Chocolat, because this is an enormous premium to last night's closing price. I mean, it does suggest that there's some real misallocation of value going on in these mid to small caps.
Absolutely. I mean, it's a pretty spectacular announcement today, with the shares up at nearly 170% on the close last night. So, yes, there is value in UK small and mid caps, absolutely. And Mars have taken an opportunity to pick up a company with a weak share price.
We're seeing so many of these companies being scooped up on the cheap, though. I mean, there's another one today, City Pub Group, being bought by Young's.
Absolutely. I mean, you know, it's the FTSE 250 has been a bit bad place to be for the last 18 months, you know, as investors shy away from the UK market, given the UK's ongoing concerns. But absolutely, it's another example of some very, very good businesses in the UK being acquired by overseas purchasers.
Now, what about Burberry? I mean, the shares sold off last week when we got these profits warnings from the likes of LVMH, but it's off another 10% today.
Yeah, so the first half results were pretty much in line. It's all about the second half and where we go from here. And as you say, the sector's under the cosh, really, because of a general slowdown in spending across the world, particularly out of China. I think Burberry's issues are a bit specific to them. You know, they are selling their core brands okay, but accessories are not going so well for them, so leather goods were down. And what this suggests is they're going to have to spend quite a lot more money on advertising and marketing, and that will hit their margins. So, you know, I think the jury's out. I think the share price reaction is fair, and we have to see, you know, over the next few quarters how Daniel Lee's efforts go.
Now, we've had the big news this week, big drops in inflation in both the United States and here in the UK. Markets have been celebrating. Are people getting a bit too overexcited about when the Fed and the Bank of England may start to cut rates?
Possibly. We've had a pretty strong reaction in equities and bonds over the last 7 days. And there is an argument to suggest that markets may now start to be getting ahead of themselves. And certainly some of the central bankers speak has been trying to temper that excitement. It's clear that the central banks are going to be data dependent, and we'll just have to see as we evolve into next year and see when these cuts eventually come.
All right, Freddie, good to see you this morning. Thanks for joining me. Now, continued strong demand and the benefits of recent acquisitions have helped Halma, the safety, health and environmental technology company, to record half-year sales and profits. The FTSE 100 business reported an adjusted pre-tax profit of £177.5 million for the 6 months to the end of June. That was up 3% on the same period last year. Sales growth was strongest in the safety sector, which provides products and services including fire detection, elevator safety and motion sensors for automatic doors. Well, joining me now, I'm pleased to say, is the Chief Executive of Halma, Mark Ronchetti. Mark, good to see you this morning. Your sales across the board were ahead by 9%. How much of that came from price and how much from volume?
Yeah, morning, Ian. And as you say, really pleasing set of record results this morning. In terms of that revenue growth, our businesses are in those markets that have got that long-term demand, and we're in those niches that mean that whilst we have pricing resilience, it's not a lever that we're pulling to drive our growth. On average, we tend to see between 1% to 2% in terms of pricing impact on our revenue, and it was around that level in the last 6 months.
Sales growth was almost as strong in mainland Europe as it was in the United States. That might surprise a few people, given that the US is growing far more rapidly.
Yeah, I mean, we had good growth across the entire portfolio. We're geographically diverse. As you say, pleasing growth in the US and strong growth in Europe. And really, it comes down to the individual businesses and the markets that we're in within those geographies. So our European growth was driven by strong demand for our ophthalmology products, and also really nice demand coming through in terms of our health and safety products. So yeah, good demand all across all regions in the 6 month period.
Now, I mentioned in acquisitions in the introduction, I think you've completed 5 so far this year. Have you still got a fairly full M&A pipeline?
Yeah, really exciting in terms of the M&A. We've had a couple of good years and we've continued that momentum into this year, as you say, with 5 acquisitions. And our approach to M&A is a little bit different to others in that we're looking to buy businesses that would arguably not be up for sale. So we're looking for privately owned businesses in those markets with those long-term growth drivers that we see Halma as a good home. So we're looking to build those relationships with those business owners. So in our pipeline currently, we're talking to owners of around 600 businesses across health, safety and the environment. But as I say, it's much more about a relationship build. So when that time comes to find a good home for their business, Halma is the place for them to come.
Now, your research and development spending is around 5.5% of sales, which is on the high side for a UK company. What are the priorities for you right now with R&D?
Yeah, our R&D and that continuous investment in our business is a really key pillar of that long-term delivery of growth. So our businesses, we run an autonomous model of around 50 operating companies. Each of those are making their own decisions in terms of where to invest to ensure that they're delivering the appropriate innovative products to solve their customer problems. So it's very much bottom up. In terms of the areas of focus, it's been very consistent actually across health, safety and the environment. So very much focused on development of new products to keep meeting those demands of our customers and ultimately deliver against our purpose of making the world a safer, cleaner, healthier place.
Now, you've spoken in the recent past about issues with chips, particularly for your safety sector. Is that less of an issue now?
Yeah, it was fantastic to just, again, coming back to that agility. Those individual companies that are close to their suppliers, close to their customers, really close to their markets, and having that agility to make the decisions. They've worked through that so well, and we've seen that come through in our safety margin in the first half, which is recovered back to more normalised levels. So fantastic jobs by the companies there.
Now, we've got an autumn statement coming up next week. Anything that you'd particularly like Jeremy Hunt to be doing?
I think as everyone, as CEO of Halma, my focus is on the delivery of our business, being really clear on our strategy and then executing against it, as we've seen in the first 6 months. All of that said, anything that can bring stability, anything that can bring confidence in growth has got to be a good thing for us as UK companies.
And what about recruitment? Obviously, you employ many thousands of people around the world. Are labour markets tight everywhere, or are there geographic variations?
I think they're beginning to loosen. I mean, we've got a very strong proposition. We've just seen we're in a business that's growing. We're in a business that continues to invest, and we're in a business that does good in the world. And that's a really compelling proposition for people to join us. So, I mean, as everywhere, our individual companies may have those challenges, but it's not something that is slowing us down, as you've seen in those first half results.
OK, Mark, it's a very, very busy day for your results day. We do appreciate you sparing a few moments to speak to us. Thanks very much indeed.
Thanks, Ian. Take care.
Still to come here on Business Life, a jump in half-year profits at Investec. I'll be joined by its chief executive after this short break. Don't go away.
We started 7 years ago because things were getting so expensive, and taking children to see Santa anywhere was £10-15, but we can do that. We're not in competition with the wonderful garden centres. No way. Children can just come completely free and meet Santa. We're supposed to start at 9, but the phone started at 7:30 in the morning. And by 5:20, we'd booked all the slots, and the 10-minute slots, children come 10 minutes interval. We'd had 466 children booked in.
Wow.
188 time slots, and unfortunately 5,000 missed calls.
I think Pamela once worked it out that if Santa was available in July and did exactly what he's doing next couple of weeks, that would just about cater for most of them. but he can't fit us in, unfortunately.
Oh, no. Oh, come on. He only really works one night of the year, doesn't he? Surely he could start in the summer to get through everyone in West Yorkshire. But I understand your point. Tell me why you do this, because obviously you like to bring joy to the families of West Yorkshire. Like you said, Christmas is such an expensive time for families who are feeling the pinch. But you're asking for donations. Talk to me about the cause you're supporting by doing this.
It's Santa's chosen charity, which is the Yorkshire Children's Trust.
And that charity looks after any children in need, a lot in hospital, and they work tirelessly for families of the children as well, all year round, not just at Christmas, but all year round.
Slay Emirates, slay better. Fly Emirates, fly better. Thank you.
Welcome back. Now, the benefits of higher interest rates, as well as growth in loan volumes, corporate deposits and funds under management, have helped Investec report an adjusted operating profit of £441.4 million to the 6 months to the end of September. That was up 11% on the same period last year. But shares of the London and Johannesburg listed lender have fallen by 1.75% this morning after warning of an increase in expected loan losses. Well, joining me now is Chief Executive of Investec, Fani Titi. Fani, very good to see you again this morning. Let's get the bad news out of the way first. What sectors are causing you most concern in terms of impairments?
Good to see you, Ian. As we indicated in our results, we are not concerned about the level of impairments given where we are in the credit cycle. As you say, we have net interest to cover any impairments. In fact, in our South African business, our impairments are lower than where we'd expect them. In our London business, where we've recorded in the bank a 60% growth in profitability, our impairments are just shy of 40 million on a book of 16 billion pounds. So we think we are not really that concerned about that number. We are not seeing stress on our clients that seems to be systemic at all.
OK, well, that's good to hear. I mean, interest rates have obviously benefited you in both the UK and South Africa. What are your expectations now on where they go from here? I mean, it looks as though the Bank of England has probably finished tightening. What about the Reserve Bank of South Africa?
We would expect that as inflation softens, and we're really quite pleased with the latest inflation print, both in the UK and in South Africa. So we would expect a pause, and hopefully in another 9 to 12 months, start to see interest rates coming down. I think that will be really helpful to the economies in which we operate, because we do realize that there's a cost of living pressure here in the UK. Economic growth is somewhat flatlining, and that is the case also in South Africa. We can do with more activity, and lower interest rates would help that.
Now, the big event for you over the last 6 months has been the completion of the merger of Investec Wealth with Rathbones. Is it too early to say how that is panning out?
The merger completed on the 21st of September, so it's really too early. But remember that the industrial logic behind it was that we created a discretionary fund manager of scale with 100 billion sterling assets under management and administration. So over time, we expect that we will benefit from the benefits of scale. We'll be able to invest much more aggressively in technology, and we will be able to offer more services to our clients. So we remain fundamentally excited about the prospects of the enlarged Rathbones.
You've talked in the recent past about potentially cross-selling Investec banking services to Rathbones clients. Are you already making progress on that front?
Look, we've concluded a formal arrangement with Rathbones that allows us to service their clients with respect to where they can refer business to us if their clients would like to take up credit. And similarly, our high net worth clients require wealth services. And over time, we've been able to refer clients to Investec Wealth and Investment. In future, we will refer them to the enlarged Rathbones. Again, there's a track record of delivery. I think in the last year, we had referred about 500 million pounds of assets to Investec Wealth and Investment, and we hope to continue to see those types of flows into Rathbones as the merger settles down and the working relationships are bedded down.
And briefly, if you would, please, the last time we spoke, load shedding on the South African power grid was a big issue for the economy. Does it remain that way?
That remains the case. Needless to say that there's urgent action that is being taken from the government side to try to address that issue. There's a lot of investment from the private sector to bring in more generation into the grid. So the experience over the last 6 months or so has been better than what was the case priorly, but we still have constraints from load shedding. We have constraints from the rail and port networks, and we have high levels of crime. And these are the three areas that have been prioritized by the private sector to assist government to try to move the country forward.
OK, finally, we have to leave it there, I'm afraid. Good to talk to you as ever. Thanks very much indeed.
Thanks for having me, Ian.
That's it from me. I'm back at 4:30. Hope to see you then. Stay tuned. Jane Secker's up next. Cheerio.